You think you're trading the market, but in reality, you're just liquidity. That single line separates amateurs from professionals, dreamers from decision makers, and retail traders from institutional giants. The market isn't a random battlefield of buyers and sellers. It's a chessboard. Every move you make, every order you place, every stop loss you set, it's all part of a much bigger game. A game where your trades, your emotions, and even your fear become the tools that fuel someone else's profit. When most traders open their charts, they see candles, indicators, patterns, and colors flashing on the screen. They think those charts are neutral, a simple reflection of price. But smart money doesn't see charts. They see intentions. They see where liquidity lies, where traders are trapped, and where pain will soon be felt. The truth is, markets don't move because of news or emotion or luck. They move because large players, institutions, funds, banks, and algorithms need liquidity to execute massive orders. And here's where it all starts to make sense. Suppose an institutional player wants to buy $500 million worth of a stock or currency. If they simply hit buy, the price would explode upward instantly. That would alert everyone that something big is happening. So what do they do instead? They manipulate liquidity. They use tactics that push the market down first, forcing panic, creating red candles, triggering stop losses, and generating fear. That fear-driven selling provides exactly what they need: liquidity. Retail traders panic sell, providing the volume for institutions to quietly accumulate. Once they've built their position, the market reverses hard, leaving retail traders shocked, angry, and wondering why the trend suddenly changed. You see it every week. The clean breakout that fails, the perfect support that breaks by a few pips and then rockets back up, the false move before the real one. These aren't coincidences, they're engineered. Because every time the market moves, someone profits, and someone provides the liquidity for that profit. Let's talk about accumulation and distribution. These two words define how smart money operates. Accumulation happens when institutions are buying quietly while retail traders are scared. Distribution happens when they're selling quietly while retail traders are greedy. When the news screams crash and fear spreads through social media, institutions start buying. When the headlines celebrate record highs, they're already selling. They don't trade the news, they use it. This cycle repeats again and again. 1. Manipulation. The market creates emotional imbalance, fake breakouts, quick spikes, stop hunts. 2. Accumulation. Smart money enters slowly, often against retail sentiment. 3. Expansion. Price moves strongly in their favor once the retail side is exhausted. 4. Distribution. They start closing their positions as retail jumps in too late. Every chart pattern you've studied, head and shoulders, double tops, triangles, flags, they all emerge from these liquidity dynamics. What you call a pattern, institutions call a trap. Think about it. Every time you place a stop loss, it becomes a target. That's how the market ensures liquidity exists. Stop losses are resting orders, guaranteed buyers or sellers waiting at specific prices. Smart money knows exactly where these orders cluster, above highs, below lows, near round numbers. They use algorithms to detect these zones and plan their executions around them. Let's visualize an example. The price has been consolidating near a resistance level for hours. Retail traders are watching, saying, "Once it breaks out, I'm going long." So they place buy stop orders above resistance. Institutions see this liquidity building. When the time comes, they push price slightly higher, triggering all those orders. Retail traders enter in excitement. But what happens next? The price instantly reverses. Those same traders are trapped in losing positions. Institutions use that surge of liquidity to sell their positions at perfect prices. Within minutes, what looked like a breakout turns into a fake out. That's not bad luck. That's how liquidity traps work. Now let's go deeper into order flow. Institutions trade using order flow, the actual stream of buy and sell orders coming into the market. They analyze where the largest clusters of orders sit and how quickly liquidity is being absorbed. They use hidden orders, iceberg orders, and dark pools to mask their true intentions. Retail traders, on the other hand, rely on indicators that lag behind price. Moving averages, RSI, MACD, all of which reflect what already happened. By the time a retail trader reacts, institutions are already 2 or 3 steps ahead. Have you ever wondered why, right after you enter a position, the market suddenly goes the opposite way? It's not coincidence. It's structure. The market needed your order. Your entry added liquidity. The moment your position got filled, the big players had enough fuel to push price the other way. You didn't lose because your analysis was wrong. You lost because you entered where everyone else did. Let's take a look at liquidity zones. These are areas where large clusters of orders exist, typically above highs and below lows. The market moves between these zones like a magnet. Every big move starts with one liquidity zone being taken and another being targeted. When price breaks a key level, it's not always continuation. It's often collection. The move exists to trigger stop losses, fill orders, and rebalance liquidity before the real direction begins. For example, imagine a strong uptrend. Everyone's bullish. The market forms a clean higher low and starts climbing. Retail traders jump in, but institutions need to buy more. The only way to do that is to create liquidity below the lows, so they push price down temporarily, hitting all the stop losses of those retail traders. That sudden dip creates a flood of sell orders, exactly what institutions need to buy cheaply. Once they've filled their orders, price shoots up again. Retail traders re-enter, thinking the trend is back, but smart money is already taking profits. It's a psychological war disguised as a chart. The market manipulates emotion. Fear to make you sell when price is low. Greed to make you buy when price is high. Hope to keep you holding losing trades longer. Regret to push you to chase the next move. And while you're feeling all that, the institutions are executing without emotion because they're not reacting, they're planning. Now, here's something most traders overlook: timing. Institutional moves don't happen randomly. They occur during high liquidity sessions, the London Open, New York Open, major economic releases. Why? Because that's when the most retail traders are active. More participation means more liquidity. The volatility during these sessions isn't just chaos, it's execution. When volatility spikes, it's not a signal for retail traders to trade the move. It's often the time when institutions are completing their orders. Let's talk about volume and imbalance. When price moves sharply in one direction, but volume doesn't support it, that's a sign of manipulation. Institutions can move price temporarily with low volume just to trigger reactions. Then, when liquidity floods in from retail traders chasing the move, they fill their real orders. This is why volume confirms trend isn't always true. Volume often creates traps. Smart money understands this deeply. They don't predict the market. They design scenarios that create liquidity where they need it. And here's another layer most never see: news events. Ever notice how the market spikes in both directions right after big news? Non-farm payrolls, CPI data, FOMC meetings. Price goes wild, hitting stops on both sides. That's not confusion. That's liquidity collection. Institutions use those moments to trigger every stop, sweep both sides, and then move price where they intended all along. Retail traders see volatility and think, I can catch a quick move. Smart money sees opportunity to take your order. So, what can you do about it? First, stop thinking like a retail trader. Stop reacting. Start observing. Instead of asking, where is price going? Ask, who needs liquidity here? When you see price consolidating, don't rush in. Wait for the manipulation. Wait for the fake move, the stop hunt, the liquidity sweep. Then trade in the opposite direction once the traps are cleared. Second, understand market structure beyond trend lines. Look for displacement, strong moves that break structure, followed by retracement back into previous liquidity zones. That's where smart money enters. Third, embrace patience. Institutions operate on higher time frames. They're not scalping every 5 minutes. They're building positions over hours and days. If you slow down, align with those cycles, and stop chasing quick profits, you'll start trading with them, not against them. The market doesn't reward the fastest. It rewards the most patient. And most importantly, control your emotions. The market is built to exploit greed and fear. Every spike, every fake out, every false breakout. It's designed to make you feel something so that you act without thinking. The moment you detach emotion, you start seeing the market for what it really is: a constant dance between liquidity and manipulation. Here's the truth. You don't have to predict the future to win. You just have to understand how smart money operates. You have to stop being the liquidity and start identifying where the liquidity is being taken. Because when you recognize those moments, When you see the stop hunt happen, when you see the fake out fail, when you see structure shift, that's your edge. The difference between you and the institutions isn't knowledge, it's perspective. You're taught to follow signals. They're taught to follow liquidity. You react to patterns. They create them. Once you see that clearly, you'll never look at a chart the same way again. So next time the market takes your stop loss, instead of getting frustrated, ask yourself, who benefited from that? Whose order got filled when mine got hit? You'll start to realize the market isn't hunting you specifically. It's hunting liquidity. And as long as you place your trades where everyone else does, you'll continue to be the liquidity they need. But once you start thinking differently, once you start seeing liquidity zones, manipulation phases, and order flow behavior, you begin to step into the other side of the game. The side where trades make sense. The side where emotions don't control you. The side where patience and logic finally pay off. You think you're trading price, but you're actually trading psychology. Every candle is a reflection of crowd behavior, fear, greed, doubt, and pain. Smart money simply uses that behavior as a map. And when you start studying the crowd instead of following it, you finally stop being part of the liquidity. If this video helped you see the markets from a different perspective, if you finally understand why your stop loss gets hit right before the move or why perfect setups fail, then you're already ahead of 90% of traders out there. Because awareness is the first step to mastery. Don't just trade charts. Learn to read the hidden language behind them. Follow the channel for more deep dives into institutional trading psychology, order flow, and smart money concepts explained simply. Subscribe, turn on notifications, and start trading like the ones who move the market, not the ones feeding it.